Hi, I'm Chris Reid, Managing Director and CEO of ASX 300 listed company, Neometals.
Chris, good to see you. Lots changed since we spoke back in August. Let's start with the positives. Always a good thing to do. Lithium. We've got more lithium.
Yeah, look, I think it's fair to say that, over the last couple of years, we moved to the other end of the lithium supply chain with the lithium-ion battery recycling that's going really, really well. We've got a downstream lithium chemical technology that we own 70/30 with MinRes. We haven't had an upstream lithium asset for a while, and we were alerted by actions of our neighbours that a legacy nickel project indeed had some potential for lithium. And I think we probably made the cheapest lithium discovery ever. We basically mined the database, went back and discovered sort of 20 pegmatites, no lithium assays at all. Got the boys to go out and get 11 of the 29 historic holes. That's all that exists because it started back in the 70s. And, we discovered spodumene in the core. They confirmed it with a black light. We've now cut it and put it in for assay. But, now we've got a lithium project on the Mount Ida fault that holds a number of prolific deposits. Lots of action. Look, I feel like a kid in a lolly shop.
Well, you would do, because I think lithium pegmatites seems to be the catchphrase of the summer. Lots of companies kind of diving into that and benefiting from that. But you're going to have to work out how you value that, monetize that, and actually then go and try and fund the development of that asset. So how are you coming at this? Early days, but you've got a ton of historic data. So what do you do?
Yeah, well, look, we're at the fortunate position, the geology and the emplacement of the pegmatites is analogous to Mount Marion. So, host granites, cross-cutting Proterozoic dikes across a greenstone belt, and then the pegmatites come up as intrusions. We have north of, so there's a dike that sort of cuts the tenement, the geology sort of halfway. North of that, we've got multiple intersections in diamond core. South of that, there's absolutely no drilling, but more than 2 kilometres of mapped pegmatites. So, for us, we have to go back through 50 years of data, build a multi-layered digital database, have a look spatially, where the spodumene is, which of the 2 potential deposits in terms of granites that the pegmatites have come from. We're pretty confident that we've got one, and essentially run the same sort of algorithm that we used for lithium exploration in a previous life that resulted in, taking Mount Marion from a prospect through to the world's second largest hard rock lithium producer.
Right. Obviously, that worked out well for you previously with Mount Marion.
Yeah.
In the context of what you've been doing recently in terms of spin out of the nickel, in the context of actually trying to, in terms of first mover advantage in things like lithium, which is just getting, I think the market's getting fairly swamped here. How do you play this one in terms of the funding component? Develop it yourself or spin it out? Oh,
look, you're a long way there. In terms of trying to quantify the value, that'll take us at least 6 months to a year to get a handle on how big this could be. In terms of the tenement size, it's 55 square kilometres of tenure, 8 kilometres of strike of the greenstone package sandwiched between the two granites. It's the tenement size is 5 times that of Mount Marion and multiples of the strike length, right? And it's really about, south you've got it outcropping, but you haven't got any drill intersections because there's no drill holes. And then north you've got drill holes, but it doesn't outcrop at the surface. So you'll have quite a lot of data mining over the next couple of months as we prepare to probably go in with geochemistry to identify, what will be lots of targets. I mean, there's 13 pegmatite bodies that have been identified. In terms of where you would drill it, I think you probably drill it eventually south of the dike where it's at the surface, and you go down. So you'll add the most amount of tons quickly. It's it's not going to be a massive spend for us. We're pretty thrifty in terms of our main focus. It is the battery recycling plant or battery recycling business. Prime Mobius currently, we've mobilised to site to build Mercedes-Benz, one of the marquee brand companies, a lithium battery recycling plant, right? And then we've got a 10 times scale up that we're looking at with Steel Company of Canada. So it's no change from the core business, in terms of, the Barrambie project and the vanadium recovery project. Some of the geological team and the executives who, one developed Wodgina as the world's biggest tantalum mine before it was lithium, they're still resident in the company, right? So we've just switched some of the resources to focus onto this. So,
let me just stick with this, because I think it's really, really important that we investors understand the thinking, the strategy, and the plan, and make sure there is one which is comprehensible to us. So, just sticking with lithium for now, is given again what you learned about Marion, it was a different time in terms of lithium's migration to where it is today in terms of valuations that we're seeing around the world, right? So it was early. Do you think you got a good price back then? Could you have held on to it and sort of benefited from what you see today? Obviously, fortune telling is a great skill. I'm sure you've got it in the locker somewhere, but does it affect the way that you think about the value of what you're talking about now with these lithium pegmatites? And
well, look, it does. I mean, you have a look at what's happening, in terms of in the spodumene world in Western Australia, and there are some fantastic valuations sitting on undeveloped resources, right? And they're not even, some of them just haven't made a resource yet, but have values in the billions. And I think, in terms of what's happening in the lithium world, I'm pretty confident we're bumping along the bottom of the lithium chemical price. I mean, we always have had a very, very strong correlation with the lithium price. It's about 0.8 correlation, right? So, our shares, unfortunately, have been down more than 70% in the last 12 months. The lithium price is down 70% from October last year, right? So it's largely sentiment driven. And look, we're no lone soldier. All of our peers, have had similar, declines in their values. So the spodumene guys really, really haven't. And I think that's because China, as the largest market and the largest growth going forward, and the fact that the Chinese penetration of EVs in the West is much higher than we forecast, we know that they're more likely to be successful in the lower end car market than perhaps the Western car makers might be. I mean, the CEO of Volkswagen said the Chinese EV makers are an existential threat to some of their brands, presumably not the top brands. So, if China, and I believe they will be successful in mass penetration of lower priced EVs, that the majority of the lithium is going to come from spodumene, because that's where it's come from historically, right? They're the world's biggest converters of spodumene, particularly from Australia, right? And the brine developers and brine producers have not been able to add anywhere near the LCE tons than the spodumene guys have done. You've seen Greenbushes expand, you've seen Pilbara expand, Mount Marion expand, Wodgina. Then you've got, Earl Grey, Kathleen Valley, really big deposits have come online. Like, if you didn't have Australia, I don't know what the lithium price would be $100,000 a ton, right? So I think, when I see the billionaires in Australia paying for these assets, the Chinese aren't able to bid for the assets for the listed spodumene developers, because they have to go through FIRB, or the Foreign Investment Review Board. But, I bet you they'd be licking their lips thinking, geez, I wish we, were able to, but they can't.
You've got historic data. I think you said at the beginning, you didn't necessarily recognize it was a lithium pegmatite opportunity with this historic data when you started looking at it when? I mean, when did you know what you had?
We bought it in 2018.
Right. Okay. So you've had a lot of time to look at it, haven't you?
Yeah, but we've found undigitized maps from 1970 in places that we would never have looked for when looking at nickel. We very well could have, without some of our neighbours' activity, it may have gone through unnoticed.
Right. Okay. And so who's that? You've referenced them twice.
St George have pegged all around us. But, West Farmers have bought into Urabanda. You got Metal Hawk on the same trend, Delta Lithium, Liontown. Having spodumene in the Eastern Gulf is probably the best address to have it.
Yeah, okay. And what happens with the nickel component? Is that just...
That'll just sit there like it has for the last 50 years. Yeah. I mean, it was really a legacy asset for us.
Right, okay. And I think there's others that I think would say, well, how convenient, what a distraction from... There's some of the other things that are going on out there in the marketplace, and I want to come back to that. But so let's still with it on battery recycling stuff where you wanted to go with Mercedes, etc. So things are continuing to move. There's no red flags we need to be looking at.
Yeah, look, absolutely. We recently announced that we've reduced battery grade nickel sulfate. That's the second largest product out of the battery recycling plant. The only one that's outstanding is the cobalt sulfate, the lithium. We made lithium fluoride out of it. So, the economics and how we sell these plants, and I mean, that is the difference in that we are selling plants under technology licensing agreements, right? We don't pay for the plants. The customers pay for the plants. So how do I sell them? I've got to sell them on the economics. One, they've got to get the materials back so that they don't have to buy it in the market. If they use our technologies, they get the materials back at the bottom end of the cost curve. They get it at the bottom end of the carbon footprint curve as well. That's what they want. They want to use the material to make new batteries. And, that's what we enable them to do. I mean, that's our core focus. Our core focus is delivering the Mercedes-Benz plant. So starting installation this quarter, starting commissioning of the spoke mid-year, starting commissioning of the spoke in September for the hub, and having it running at the end of 24. We will then move from 2,500 tonnes per annum for Mercedes-Benz to 21,000 tonnes per annum for the Steel Company of Canada. That is essentially product readiness. So line up and buy one, and we've got a fantastic pipeline.
Okay, so that's the kind of proof of concept, and fairly high standards. From my recollection of the process that you've been through, but the audience out here, the investors out here are going to be going, show me the money. So when does that start to flow with cash? Yeah. So look, we do make some money on the plant supply agreements. We have a markup on them. In terms of the royalties, so, for Steel Company of Canada, it's a 10% gross sales royalty on 8 products coming out of the plant. That'll follow in the second half of 2025 from black mass sales. From chemical sales, it'll increase markedly in the second half of 2026. So, the idea is always the first plants, the hardest. I mean, we're lucky in that Mercedes-Benz is essentially de-risking our technology. They got a 37 million euro government grant. They've built a custom-made facility for us at Kuppenheim in Germany. We've got a 5-year R&D collaboration. We're going to co-own improvements. We can use it for anyone. There's no restriction. We can sell plants to other car makers. At our Hilkenbach disposal service, we service all the German car makers and their supply chains. Between now and then, in terms of not just the kind of, I guess, sustaining capital between now and actually ramping up and flowing cash, do you need to pump more money into that joint venture? Look, I'm sure with line of sight to, near-term revenue, it's not necessarily going to be expensive money, even if you did. But what does that look like? Yeah, so look, we will need some money to bridge us through to that point. Look, we've got a couple of quarters of cash as we put out in our quarterly. We're reducing our cash burn. We've got a few less staff than we had before, obviously, with a couple of the projects slowing down. They've finished a heavy spend, all the feasibility studies and that sort of, they're not going forward in terms of development with partners. So they're now being put on a much more austere budget going forward.
I mean, you've got to cut your cloth in terms of what's core. It's the battery recycling. There's a small draw for the other projects. I think we do have an investment portfolio, not as liquid as we can use it for treasury at the moment. We haven't raised money for more than 10 years and given $82 million back. It's a case we will need money at some stage going forward.
Okay, fine. But that's going forward into a revenue stream and in terms of the business. And I think that's the bit that people have been looking forward to, because it's hard to quantify otherwise. It's a very complex mechanism to actually quantify.
I think one of the unusual and unique things about it is, you're building a portfolio of low risk, low capital technology royalties, so you can multiply the opportunities. And so you're not restricted in one, if you did it yourself, one plant, then you got to raise money, you get that running, then that has to ramp up. You have to try to recover the massive capital costs. It looks good on an NPV, but on an ROI, it's not great. And so, we're all trying to make the most amount of money in the shortest amount of time, right? So for companies, if you can make earnings, the highest PEs are achieved by royalty companies. So we've got one peer called Lithium Royalty Corp. They've got 4 operating battery material royalties and about 12 or 13 other ones that aren't producing. Even in this market, they trade on a 69 PE, right? Because, they're different. They're exposed to the battery materials. We think we should be able to get a premium on that because we're not subject like mines to CapEx and OpEx increases like they are. Our plants will last 25 plus years. You got 8 revenue streams. So you've got diversity there. They'll be with tier 1 customers that are producing cell scrap and having end of life all the time. It's their quality. They're not one commodity, one mine, all of that sort of stuff. So, for us, we're firm believers that the royalties coming from the battery recycling, from the lithium technology, vanadium technology, that will provide a superior return for our shareholders in the long run. We haven't asked them for money for 10 years. In fact, we've returned money. We've invested money into the business to develop those technologies to the point where, we're not that far from cash flow and we've got a fantastic path. We've achieved partnerships with tier 1 parties, so we're very very, very happy. And what we can control, we've been doing a good job on. But obviously, when you look to de-risk and bring in partners, you can't always control your partners. So with our partners in the titanium, the offtake terms were good, but they wouldn't put up a prepayment or equity terms. So you can't move ahead. Like I'm not going to bet the company's money on it. In fact, we were hoping that would be a source of income immediately by selling them some equity. In terms of the lithium joint venture with Bondelti, or the cooperation agreement where we're co-funding the pilot plant, they'd set up a new lithium SPV called Lithium, and we were negotiating back-to-back agreements. Unfortunately, we didn't get to match them up perfectly, but we're still committed to co-funding, and we're doing the pilot, and we put the results. The first half of the pilot and the technology works fantastic. The second half will work. We don't have to put our hand in our pocket till the end of March. And if we get past the next hurdle, they will be funding, most of the costs. It's a very, very little. It's like a free call option for us, in essence. The vanadium technology, well, we were looking to do 160 million euros, and the market's just got worse. The prices have gone down. We got the debt, approved by the management team at the EIB, and that's going to the board. We've got to take a pay off take with Glencore for the end product. We had approvals in record time, a lease, feedstock. And now what we're trying to do is help the PE fund and just say, well, look, if you take it, we can license you the technology. You can buy the project company, and we'll just have a contractual relationship. We just won't be partners. So, it's what you can control. We do well, but you can't always control what your partners do. So sometimes when you want to partner and take down the risk, minimize and the risk to the shareholders and maximize how far your money goes, you do surrender a little bit of control.
Okay. So these are the harsh realities of business. We're speed dating, and so just want to be clear: is the vanadium element is not dead in the water, and as there is some gain. It is.
I've got to say, I think there's more technology licensing opportunities as I see it than the lithium chemicals. The lithium chemicals is probably 6 to 12 months away from that. Obviously, we're at that stage with the battery recycling. Barrambie has been put on essentially, the drip feed while we engage with some of our other interested parties. It's a significant. It's still a strategically significant resource.
Yeah, but do you do that from a weakened position? Do you do that, or do you think you still are in a position of strength? I mean, you have the asset, obviously, but
I don't have a gun. I don't have a gun against my head for it.
But you said the clue there was, Chris, earlier. You said, effectively, time is money. You want to return on investment at the quickest time possible, because that defines your the value, right? So, do you feel there's a gun against your head in terms of time pressure, not necessarily who, but how much you get, still in play, right?
Well, not for that project. I don't think you throw out projects. Where are we in the cycle? We're certainly closer, if not at the bottom, than we are to the top, right? The holding costs are very, very manageable. We've got good interest from other parties. We're just not going out and finishing a feasibility study, right? We were flat out doing all the test work ahead of a feasibility study. But, at the end of September, start of October, we basically said, well, if you're not going to buy equity or put in a substantial prepayment to bring the project through the feasibility study, we've got to down tools. I mean, we are rational people.
Okay, so let's say, but business and stuff, and there's the harsh realities of negotiating deals, and you're not going to get into bed. I don't know where I'm going with this speed dating and getting into bed with people, but you
I think there's something in there.
Yeah,
I'm not.
So careful what phrase I use next.
I'm not a psychologist, right?
Right. Okay. So things you have control of, you can be in control of, and you're not going to be rushed into this, and not necessarily under any financial pressure either. Disappointing time in a disappointing and tough market, but the blue skies come from where? What do we have to look forward to, and in terms of what you can control? How do we drive the share price up?
Yeah, look, it'll be sticking to the timetable for Mercedes-Benz. So essentially, 2024, you de-risk it, and in 2025, you deliver it to the world, at scale. And then, probably in 28, we'll go to the next level. So, we're going, the Mercedes plant's a factor of 10 scale up, then we go up by a factor of about 8, then we'll go up by a factor of 10 to get up to our target of 200,000 tonnes per annum in terms of plant size. By that stage, the market will be, 10 to 20 million tonnes per annum of cells. And when we have a look at it, I mean, you can't ring up Glencore and Umicore and these sort of guys and they'll sell you a plant. They're in recycling because they need the feedstocks, right? And they need to have recycled material, and they need to have security of supply. Whereas our model is, we want to sell plants and supply plants to the people that need them. The car makers are going to need them. The cell makers are going to need them, and merchant recyclers are going to need them, right? And you have a different level of proof. So we've got the flow sheet. We've got half the business with SMS, but SMS are building the plants under contract to Primobius. They're a 150-year-old German plant builder. The plants, we've got to hit KPIs, throughput guarantees, warranties, all of this sort of stuff. It's a different level when you're looking to sell plants as opposed to, I've got a flow sheet and I'm going to get an EPCM engineer to build it. He's not giving me a fixed price. It could, how long's a piece of string? It might take me years. High inflation. Like we're supplying plants to Mercedes-Benz under fixed price contracts. The level of risk assessment and certainty that you must go through, the diligence between that and trying to do it as owner-builder, are chalk and cheese. right? Miles apart. So, the product that we've got is leading.
No, I hear you. And then with regards to, so I forgot to really sort of talk about Ely much. What's happening there
with the lithium chemicals?
Yeah, in the sense of where's the upside?
So the upside there is commercializing the technology in like a real plant, right? Run by one of Portugal's largest companies that has Portugal's largest chemical producer in the group and a dedicated lithium business, right? So, when you develop technologies like this, you normally have to put your money into the first plant, right? Our technologies, and we've spent money on them and we've got them to the state, and our partners are that confident that Mercedes is paying for the de-risking and operating at 2,500 tonnes per annum, right, for the battery recycling. You've got the Portuguese for Ely. For the vanadium project, we were looking to do it and bring in a big PE fund and we were going to water down. Now we're just trying to do it by technology licensing and selling them the project SPV. Certainly that's my wish. And so, we may be in a unique position where we're able to commercialize technologies without having to put any material money into the first commercial plant. That's a testament to the technology and the tier one partners.
It's a case of needing to be agile or adaptable to market conditions, and there's still some upside there, as far as you're concerned.
Look, we could all, in a different market when capital's much cheaper and freely available, we can deploy it as principal or in joint ventures. If you have the balance sheet, you can take on more risk by doing it yourself, right? But in this current market, the low capex, low risk method is just to license the technology, don't put in capital, actually make money on someone else's capital spend when they buy the plant, and then charge them revenue-linked royalties. So minimize your cost base. That's the strategy.
I'm glad you went there, because I think the next question was going to be about, look, in 2020, we all looked like geniuses. The CEOs looked like geniuses because the market was doing the heavy lifting for them. Investors looked really smart because the market was doing the heavy lifting for them. But in moments like this, where capital is tight, it's expensive if you can get it at all. It's a different environment in which to operate. Do you, looking back, think that you took on too many projects? You had a lot of moving parts, a lot of revenue opportunities, but a lot of liabilities in terms of time, money, and effort. So if you had your time again, would you go at it the same way?
Where we are at the moment is in a fantastic position, right? The technologies that we've developed give the shareholders exposure to royalties on 5 of the top 6 most positively impacted commodities as forecast by the World Bank out to 2050. The only thing I don't have is a technology in indium. I'm not even quite sure what indium is used for, other than it's pretty rare and I believe it's in phones, right? To make the screen red or something like that. But, what we've got, and we use the shareholders' funds to do that. In a different market, last year we had a market cap of 1.1 billion, right? So I think that was a pretty wise move for an endorsement of what we did. Obviously, the market got ahead of itself. I mean, we were pre-revenue and no order book. Now we've got revenue and a growing order book. It seems counterintuitive, and what's changed is the commodity price that we're in, the battery materials prices are down 70%, right? You cannot swim against the tide. Like if you took the gold price down 70%, you'd take out 70% of the gold miners. So what have they done wrong? Wow, they've got their assets, they've got them under control, they've got them in production. But if the commodity prices go back 70%, what does that do to the valuations? It's just logic. It's unfortunate for the shareholders, right? And believe me, I'm a shareholder and a significant part of my wealth's in it, but you can't fight that, right? Like I said, for lithium, and it's bouncing along the bottom, we've got great confidence that mid next year we'll see a materially increased lithium price. So for us, it's still around the low risk, low capital business model. That's why we got into the licensing models.